Welcome to Modern Day Economics, where we have in depth discussions on everything economics, economic news, economic releases, and data that affect our families and communities all across the United States. So, today we have an economic release from the Philadelphia Fed, the Manufacturing Index, on July 18th, 2022. So, why is manufacturing and the manufacturing index important? Well, the reason for this is that generally speaking, in the situation of recession, manufacturing tends to somehow be the last industry to go down. And when things start to level out and get better, they tend to be the first ones to come back up. And the reason being for this is they tend to produce the goods that are the most essential to our economies and our everyday lives. So, what does this new report really tell us looking into it? Well, it seems like for the month of July, we see a decline. And this is in the context of this being the fourth consecutive month of decline for general activity. We're also seeing a decline in orders. And the reason why this is interesting and important is that orders serve as a prediction metric for what might happen in future periods. If there are less orders today, there may be less general activity in the future because a lot of the sales that are happening today are orders from the past. So that is also something to take into consideration and pay very close attention to. Now, as most of you here listening may know, we have had a first negative quarter of GDP growth. Recession is defined, at least in a technical sense, as two consecutive quarters of negative GDP. And next week, we actually get from the Bureau of Economic Analysis the first data on the second quarter ending on June 30th of 2022 of what the official data for GDP growth or positive or negative may be. And this contextually speaking is very interesting to look at. There's many voices in the industry that say that there may be a negative number. The I believe it was the Atlanta Fed came up with a prediction for a negative number below negative 1%, if I remember correctly. I think the first quarter was negative 1.6%, if I remember correctly. So, kind of seeing that for the past 4 months, manufacturing has gone down, this can kind of contextually at least allow us to understand and better interpret the data once it comes out next week. When looking at the report that the Philadelphia Fed put out, it's also interesting to see how it highlights the increases in price. So it seems like most of the manufacturing organizations that were surveyed in order to put this index together, I believe it's nearly 56% of the companies that were surveyed reported an increase in input prices. And of course, if their input costs go up, they then have to either make the decision of reducing their profitability or increasing the prices to the end consumer. So if you're a producer of widget A, and it costs you more for the raw materials of widget A, you may charge more for the finished goods once they are sold to the storefront or electronically or whatever method of sale there is. It may cost more to the end consumer, which further amplifies inflation, very unfortunately, for individuals that are concerned about this. Another very interesting component, of course, we also see that there's an expectation of higher prices of raw materials, as we just referenced, which, of course, is probably a very good reason why there's increases in input costs, but also the increased cost for energy. Now, why is this important? We all seen gas prices increase over the past year and past few months, but also the cost of electricity, cost of natural gas can be other ways that energy can go up. And when energy goes up overall, that is a cost that a business has. And when energy goes up for a manufacturing firm, that reduces their profitability, and they may be forced to increase prices to the end consumer. So that is also something to certainly take into consideration. We all know that interest rates have been going up, which if a manufacturer utilizes a line of credit or any other form of debt, either new debt or debt that has a variable rate, that increases their debt service cost. So that would also further put um, pressure on their profitability and potentially put them either in a bad situation or in a situation where they need to raise prices to the end consumer. So that concludes the analysis of the Philadelphia Fed Manufacturing Index release. Thank you all for listening today to the Modern Day Economics podcast, and tune in to stay up to date with economic releases and economic data that affect our communities and families. Thank you for listening.